Hello and welcome back to Pay Down Debt Solutions. Today is the day that I am going to validate all of those naysayers about velocity banking. So today, those of you that say velocity banking does not work, you're going to get your heyday for about a minute, okay? So today is a really important day because we had a great student scenario, okay, or where we had students come to us that they're a younger couple, and by younger because we know our average age out there, people that are really in debt is 40 to 70, right? So these guys are in their late 30s. I believe the husband will be turning 40 this next month, and they found themselves in a little bit of a conundrum. Okay, so they had a bunch of debt, and they took their debt and they decided to roll it into a home equity loan, right? So always a line, never a loan. So that is what we always say, correct? Okay, so they turned around and they rolled this into a home equity loan, and then they decided that they were going to, continue to watch these channels such as ours here about velocity banking. And after they had done that, they immediately had remorse about the home equity loan. So they ended up contacting us and, going over their situation. And they said, well, at this point, should we just turn around and put our home equity loan and turn it into a home equity line of credit? And I said, not necessarily. Okay. So today I really want to go into something that's really important because you guys, it would be remiss of us if we did not tell you every in and out of velocity banking, because there are situations where velocity banking does not work and it doesn't make sense. Now, remember, when we do our workshops with you guys, and this is what is so important and so great about the workshops, is that you're going to work your own numbers. Okay. So we bring you all together in a small group, and we talk about number one, velocity banking, and we answer your questions. And then number two, we then get into each and every one of your scenarios, okay? And we work with you. Now, we work with you because your individual situation is very important. And what we go after is saving you the most interest, okay? So with velocity banking, there are times when when having a big line of credit might not always be the best thing for you. And that's where we get into working down loans, right? So we show you guys how to work down your mortgages. All right. Well, you can also work down other loans using small lines of credit. Okay. So sometimes using small lines of credit to work down loans can effectively work down a personal line of credit, personal loan, personal loan, or home equity line of credit, business loan, those types of things. Okay. And so sometimes those smaller lines make more sense. And we're going to go into that because these guys are young. Okay. So they're still young. They still have a lot of earning potential out there. And when you're sitting there with a 6-year loan, okay, you're sitting there with a 6-year loan, remember, time is money. These guys have dreams, they have aspirations, they, as a team, they want to get together and they want to start their own business, okay? And I think that's why we appeal to a lot of people, is because we are business owners, right? And so those of you out there that are learning to, or that want to start your own business, here's the thing, you guys. One thing that I really want you to remember is that, first of all, you cannot necessarily save your way to wealth, okay? The way to get to wealth is to, 5x your income, maybe 10x your income. And you can do that when you get rid of your debt. Because this debt that you have out there that is holding you back because you're paying all these payments, right? So these payments out there that are keeping you cash poor, all right, that are holding you back from earning your earning potential. All right. So these payments, when you can get rid of them faster, that is when you can really start taking your true income, your effective income, right? And that becomes maybe your 3x, right? Because right now the income that you have is tied up. It's tied up in your payments. So even if you're not going to, go out and start another job, right, and do something different to then try to 3x, 5x, or 10x your income, you can take the income you currently have right now and, and double it, okay, in many cases, your effective income, right? Because you have all these debt payments. Well, when you get rid of those debt payments, that's what happens. You end up earning more for yourself, all right? And those savings accounts out there, the reason we talk about taking your savings and slapping down on those, debts that you have is for that reason. Again, you really don't save your way to wealth. You X your income into wealth, and that is how people become wealthy, all right? So pay down your ignorance tax by learning this, you guys, by learning something new, all right? So let's discuss this situation here. So we have these students, And the problem is they just got this home equity loan, right? And so they came to us and they said, you know what, maybe we need to just refinance this baby and put it into a home equity line of credit. And Dan and I took a look at it and we said, let's wait on that for a second and let us run some numbers and let's take a good look at what's going on here. Now, they really don't have anything now that they rolled everything into this home equity loan, okay? So right now what they have for their situation is this loan, okay? And it is for, this home equity loan is for $62,341. And right now, the interest rate that they have it is at a 7.99%. Remember, that is a second lien on top of their mortgage. Okay, so they have their mortgage and then they have this second lien. All right. So they have then obtained that. Okay. And it's costing them to do this because this is a 6-year loan. Okay. So this is where do I have it? It's a 6-year loan. So it's a 6-year loan and it's for $1,092 a month. Okay. So that's what rolling all their debts together did for them. Now it did free up cash flow, believe it or not. I mean, that seems like a heavy payment, right? But it did free up cash flow for them. So they also have a personal line of credit that they've obtained for $11,500 because of the conversation that we had with them. Now let's look at this. They were approved for a personal line of credit and they opted to instead go for that that home equity loan before they got into velocity banking, before they really understood how velocity banking works. All right. So they did have this approval out there that they turned around and they ended up going and getting. And we're going to talk about why they did that. All right. So now we know that they have a mortgage plus they have a home equity loan. And of course, they did this home equity loan for consolidating debt, for getting themselves out of some of the debts that they were in. Okay, and the funny thing is I had to pause the camera there for a second because one of our lovely cats was scratching at the door. You guys, I love my animals to death, but sometimes they drive me crazy. So those of you that out there that live with animals, yes, we love them, but man, sometimes they are annoying. All right, so anyway, so we have this mortgage plus this home equity loan, right? And they did it for debt consolidation. So let's take a look at the numbers that they have, all right? So we have an income here of $4,600, all right? Now remember, they have a dream, and their dream is they want to start a business, okay? And in order to start that business, you guys, again, I always talk about this. I say it takes some money to make some money. And that is true. Either you're buying down your ignorance tax, right? And you're getting help or you're getting coaching or you're getting mentoring of some sort to learn more about the businesses that you want to start so that you become the expert so that you can 3x, 5x, 10x your income, all right? So it does cost money. And in their case, the type of business that they're going to start is going to cost them some money. And right now, this 1,092 could be put to better work for them. All right. It could be. But right now they have their obligation that is to pay down the debts that they have, the debts that they've incurred. And so that's what they've done. Right. So their income is $4,600. Their total expenses is $3,360. Okay. So they do have a significant amount of cash flow, which is great for them. All right. The business that they want to start, though, is going to take even more money. All right. So they do have some cash flow to work with. And, since they were able to consolidate their debts, they've done that for themselves. They've given themselves more cash flow. Now, their mortgage is $1,140 and their car payment right now is for $329,000. So they really don't have much on top of that because, like I said, they rolled their debts in. So the only other debts that they currently have, well, you can't really, I guess they're debts, they're obligations, let's put it that way, are their living expenses, utilities, phone, internet, Hulu, Netflix, Amazon, whatever, right? So that's what they owe currently. All right. But they've got this loan out there, this home equity loan for $62,341. And again, that's $1,092 and it's over 6 years of time. So the interest that they're going to be paying on that comes to $16,335. Now, this is where I talk to you guys about, when you have home equity lines of credit, okay, we always talk about home equity lines of credit and how amazing they are and you can roll things in and you can work down debt, okay? But interest rates also do become important, okay? And I know that I tell you guys I don't really care what the interest rates are. Well, that is when you're first starting velocity banking. You're looking at a blank slate. You've got all this debt. You've got all these payments. And you're looking at high credit card interest rate. And maybe your only option at this point is to roll some of those debts into a credit card and work down debt that way. Yes, in that case, I don't care about that credit card because you're learning to use your banking a different way. Instead of traditionally banking, you're putting your money in, you're working your expenses out, and you will save yourself some money. But in this case, had these guys taken this amount of money, this $62,341, instead of doing their home equity loan, and if they were to roll it into a line of credit, a home equity line of credit, let me be specific, that may not have been the best option for them, okay? And I say that because of the interest rates. Right now, if they're sitting at, and I ran these numbers a couple different ways for you. If they got a home equity line of credit for $11,000, and it's right around $11,000 for a second lien like that in a line of credit, they would be spending at the end of this. All right, let me get my numbers here for you. Okay, so they would have spent $19,634, okay, to run Velocity Banking Strategy at an 11% interest rate. So that wouldn't necessarily make sense, right? Because they're paying 16 here and they would be paying 19 at 11%. Now, if it was closer to 10%, they would be paying somewhere around 17 or 18. So it's closer, but it's still not quite there, right? This loan still made better sense for them. However, using and doing things sort of like a mortgage pay down, right? When we talk to you guys about chunking your mortgage down, when they take a smaller line of credit and they chunk this down, let's then see what happens, okay? So here's what happens. So now let's say we're going to take 10,000 of this line of credit that they've obtained, this personal line of credit that they've gotten for $11,500. And let's say they take 10,000 of it and they're going to slap it down on this on this home equity loan, all right? When they do that, what happens is they're immediately dropping to $52,341. And that's the start balance, right? So they're going to slap that down. But now, because they've learned Velocity Banking and they've learned a skill, they are going to then take the rest of their income, right? And they're going to run it through this $10,000, okay? So they're going to take their income, run it through the $10,000 that they have on that line, and they're going to pay their expenses out, all right? So when they do that, and they've slapped down money on this loan, here's what it looks like, okay? And just bear with me and let me go through this so I can show you what's happening here. Now, we know this is on a schedule, right? And let me show you that schedule. So what I've done, and I apologize for being off camera, is I have printed this sheet out for you to look at, okay? So this is an amortization schedule of the loan that they have obtained, all right? So if you take a look at it, you can see when they slap down their 10,000, okay? So they're going to be right about 52,432, let's say, okay? So in just using straight numbers, I didn't, calculate it down to the penny. I just wanted to give you guys an overview of this. So what happens is they're going to slap down that 10,000, okay? And then they are going to run this strategy for 5 months, okay? So it takes them 5 months to get to the point where they can make their next pay down. Now, we know that when they're running this strategy, they're paying the interest, right? So they're paying this interest here, right? So this is the interest here that they have to pay. All right, so here's my line, here's my interest, we have to pay this, okay? So you have to calculate that. That has to be in your calculations, plus the amount from what they spend in interest to run it through their line of credit, okay? So when they do that, here's what we start with, okay? We start with our 10,000 and we put our $4,600 in and we drop it to 5,400. Now remember, none of our numbers are changing here because we are not paying this off, right? We're not paying this off to then get back that $1,000. We are simply chunking it down at this point. We are doing nothing else but chunking it down and running our expenses out of that line of credit, okay? So we know that this line of credit, when you put your income in, the payment is then satisfied, all right? So the payment is satisfied. So you don't owe the payment on that. You do owe the interest though. So in a sense, I am adding interest into this calculation, right? So I'm not subtracting anything. However, I am adding some interest, okay? But you're going to see how that works out in the end for them, all right? So now we take and we slap down our 10,000, right? So we're working with this 10,000. We know we started our loan, with 52,341, okay? Because when you put it in, you run the exact numbers, that's what it's going to be. So we put in our 46, we drop our first month, we drop us down to 5,400, right? So 5,400 is what that is on that line at this moment. But we have our expenses that have to come out, right? and we have our interest, which is $96. Remember, this is a lower line. This is a lower dollar amount. So it's $96 in interest here. Okay. Now, if you'll notice here, their first month, we're going to call it their first month because the first month we put a slap down on it, right, is $354, right? So their interest is quite a bit more on this side. Okay, so we've got $96 here, and so we work it down, and so at the end of the first month, we're at $88.56. We start at $88.56 the second month, we put our income in, we drop it to $42.56, our expenses come out, our interest comes out, and as you can see, our interest has already dropped, right, using the line of credit principles that we use. And we're now at $76.97, okay? So we take that in month 3, the $76.97, we put our income in to drop it down, right? To drop it now is at $3,097. I'm sorry, $3,097. And then our expenses come back out and our interest comes back out. And again, you guys, you're seeing the interest drop each month, right? So now we end the month 3 at $65.24. So we start month 4, $65.24. We put our income in, we drop us down to $1,924. We add back in our expenses, we add in our interest, which is now at $52. And so we are left with $5,336. We start that next month with that, the $53.36, put our income in, drops us to $736. And look at this, we're almost paid off, aren't we? Our expenses come out, our interest comes out, and we're at $41.33. Now, we know what our balance here is at $11.5. At this point, we can do another chunk down payment, okay? And that's what we do. So in step 2 here, I'm taking my $41.33 and I'm adding about $6,800. Now remember, I want to leave them wiggle room, okay? I always want to leave them wiggle room because of timing, right? We all know that timing becomes important. So because of timing, let's leave some wiggle room. So then we add it together. So we start out with $10,933. Our income comes in, drops us down to $63.33. Our expenses, our interest, and you'll notice 107 is greater than the 96. And why is that? Well, look we started with an even 10 here, and this is almost 11 here. So that is the difference in the interest. And I like to point that out because every now and then I have people that say, oh, that's wrong because your number is so much higher. Well, it is higher because the whole number is higher, right? Okay. So anyway, so it drops us to the $6,333, our expenses, our income, our interest, and we're at $9,800 to start month 1. Now, again, we're going to run it for 5 months. Okay, so that's what happens. Now remember, we then go to 5 months. So we have to then look at our loan balance and where our loan balance is at 5 months of time. Well, at 5 months, we're at $48,664. We have spent $1,720 in interest. Now remember, these numbers here, if you add them up, it's going to equal the $1,720 for 5 months, all right? Our HELOC balance is that we've paid, our HELOC balance was in the next section is going to be $39.21, all right? So our interest then is $333, all right? So the HELOC balance is in 5 months is dropped to $39.21, okay, like this one was $41, this one's $31.21. The interest is $333, that is how much we've paid in interest, okay? So now we're taking our $39.21 and we're going to add $7,000 this time, okay? So we're adding $7,000. Remember, we're leaving them with a little bit of wiggle room. So now we add the $7,000 to our balance and we're down to $10,921, okay? So $10,921 is where we start our next chunk down, our next pay down, all right? So when we do that and run this for 5 months, we end up at $41,864, okay? So that, when we put the 7 on, right? So we started with the $52,341, then we get down to $48,664 after the 5 months. When we put our 7,000 against this, we drop to 41. So we're at 41,864. So now our total interest that we have spent then on that chunk down, all right, for the loan is $1,356. I actually think it's 54 because I just added the numbers again for myself. Okay, so that means that we are now, so here's our schedule, right? If this is our schedule, we're now on page 2. Yeah, page 2. So that means we're starting somewhere around here, right? So 41,558, let's say. Again, remember, these are just numbers I'm trying to run for you to show you an example, all right? And that means after 5 months worth of time, this is the interest, okay? So these three are the interest that I'm adding, and hopefully you guys can see that. And so that interest adds up to 13, I think it's 54, whatever, $2, all right? So 13, 54, 56, whatever. And our personal line of, and our personal line of credit is down to, we've paid, I'm sorry, $428. So we have to add these together, right? So here's where I'm going to stop, because my intention was to make this a pretty short video for you guys so that you could, see what's happening here, okay? So after 10 months in time, so now it's been 10 months, okay? We have spent $3,837 in 10 months. We have dropped our balance down to 41,864, okay? So 10 months, we've dropped our balance that much. Now, in 10 months worth of time, where would we be here? All right, so let's look at our schedule. In 10 months, if we left it the way it was, well, we would be right here. We would still owe, sorry guys, we would still owe 55,000. What is this? 55,357, my old eyes. Okay, so we would still owe 55,000, but running it velocity banking style, using a line of credit to do chunk downs like this has been advantageous for them, because because in 10 months time we spent 37. Now this is the most interest they're going to spend. Remember, because of the way the HELOANs work, I had to think about it. Because of the way the HELOANs work, remember, the most interest you're going to pay on that amortized schedule is at the top. And I've proved it, right? Because you guys can take a look at this and you can see the most interest you pay is at the very beginning of that schedule, right? So at the very beginning of that schedule, then, we then pay the most interest. So as we continue to do our chunk downs, we're going to pay less on the HELOAN, and of course, we're going to pay pretty much the same for the most part on our line of credit. So that will remain pretty static. The numbers won't change too much. But what will change is the amount of the interest that you pay on that loan. So that means that after 3.3 years, they're going to spend somewhere around 11,000 something, okay? You take that, you subtract that from your 16,335, and you've saved what? $4,000-ish or so, somewhere around $4,000. Now, some of you might look at that and say, that's amazing, that's great, that's a huge amount of money to save. Others of you may think, well, it's $4,000. Is it worth all of that for $4,000? Here's something to remember. You guys, once you're living this and doing this and you're just making chunk downs, right? And you're putting all of your income into that line of credit and you're running your money out of your checking account as normal because it's connected to that checking account, it's like business as usual. There's nothing else that's different than your day-to-day running it like this. There really isn't. But what you do for yourself in the end is you've saved another just about 3 years, right? Just under 3 years. You've saved time. And think about it this way. In 3 years, you're adding back in another 1,092 into your cash flow. So for these people that want to pay down their ignorance tax by learning about a new business that might 10x their income, they have saved themselves time and they have more earning potential by doing it this way than if they were to wait out the 6 years and try to build up that money to then try to learn their business, right? So you guys, I want you to think about these things in those terms, right? So again, when we bring you guys velocity banking, like I said, it would be remiss of me to say that velocity banking works for everyone in every situation. Well, it does in certain aspects, it's going to work for you, right? But you have to know your numbers and you have to understand how it works, which is why we bring the workshops to you guys, because it is more important that you understand how this works than for us to just create a plan and let you run it. You guys can do that by all means, and we're happy to do that for you, is to give you a coaching plan and like set it and forget it and let you guys run it. But I really want you to understand why you do this, because you can do this all on your own, figure out the best way to run your finances, and now you have a tool, right? You have a tool for you to use in the future because you've paid down that ignorance tax by learning something new, by learning to kick traditional banking to the curb and do it the Velocity way. Okay. So let me just give you an example too. So if they were, and I think I showed you guys numbers earlier. If they were to have rolled it into a home equity line of credit, right, and run down the strategy, they would have paid $19,000, and I'll show it to you, right, because this is our handy dandy tool that we've used or that we've built, okay, and it would have cost them $19,634, right, to roll it all together and work down that 63. Now, if they were to do this, okay, and let's say they did Velocity banking on this dollar amount at apples to apples, meaning the same interest rate. Now, we know that the interest rate isn't the same, but I want to show you the principle of this, how this works, right? So it would have taken them, okay, at 7.99, they would have spent $12,629. It would have taken them 57 months, which is, I forget what that is. Dan can do this in his head, you guys. I cannot, sorry. Okay, so 4.75 years, right? So they would have shaved off a year and a half-ish, let's say, of time running it this way, apples to apples comparison. But we know that there aren't apples to apples, which again is why we bring this to you and show you different ways to do this. These little lines of credit, you guys, or smaller lines of credit, can be very powerful if you know how to use them. This is a perfect dollar amount for this scenario right here, okay? So again, you guys, if you want to learn from us, watch our channel, watch the videos that we have from you, and know we are bringing you the honest information that we have so that you can build your best plan. Again, if you want to enter in and get into our workshops, we're happy to have you. We're working the 26th right now, and we will do some in August. But aside from that, you guys have an incredible day, evening, afternoon, whatever you come to me, whatever time it is, and I will see you in the next video.